Hi, Tom Lydon here in Chicago at the Morningstar ETF Conference. I'm here with Brandon Rakszawski, who's product manager at VanEck. Brandon, great seeing you.
Great to see you as well, Tom. Thanks.
So many ETFs, so much money that's flowing in, but we want to talk specifically about a Warren Buffett-esque strategy that you guys have, this wide moat strategy. So how did this all come about?
It's a relationship that we struck with Morningstar well over 5 years ago. So for the past 5 years, we've been talking the moat investment strategy with Morningstar. We listed a US-based product that offers exposure to Morningstar's equity research process 5 years ago. 2.5 years ago we launched Moat, an international ETF that expanded that exposure to offer a global exposure to Morningstar's best ideas, which are really rooted in their equity research process of identifying quality companies, those companies with economic moats, as Warren Buffett coined that term, but also identifying their attractiveness in terms of valuations. So making sure you're not overpaying for those quality companies.
Yeah. So what's important here is Morningstar had these indexes in place for a while. You guys got together and were able to actually bring these indexes to life so investors could actually invest in them. So if investors are fans of Warren Buffett, fans of Morningstar, fans of VanEck, you can come to Morningstar or VanEck and actually see the underlying constituents, and it's not as though it's stagnant. They trade or the constituents changed as often as quarterly, correct?
That's right. It's a very dynamic portfolio.
Yeah.
They're trying to capture these valuation opportunities in quality companies on a regular basis. So the index team is leveraging Morningstar Research to capture those top picks from their equity research team, but not overpaying. And two main points that really differentiate the strategy is the performance and the process. So the performance is really the proof statement of Morningstar's process, and the strategies both in their ETF form as well as in the underlying index have outperformed not only the broad market, but in many periods it's outperformed both passive ETF and active mutual fund peers in its space.
Yeah. Well, also you do a call. It's a quarterly call or a call every 6 months, where you actually talk about the change in constituents, correct?
That's right. Yeah, we're with Morningstar regularly, not only in calls and webinars, but we're constantly out on the road. We did a recent road show across the United States to tell the story. So we like to highlight not only some of their research through their different stock picks, but also talk about why companies come in and out of the index, primarily on that valuation side of the equation.
Now, I know there's a lot of companies coming in and out, and not everyone's a winner, but I'll tell you, I will never forget the fact that when Facebook went public, you guys didn't put it in. It ran up and then it went down, and after it went down, it actually made it into the index, which blew me away because at that point it hit the right levels, correct?
Yeah, that's what's so critical about this strategy, and that's what the beauty of combining both quality and their valuation metrics give you. Because you can invest in quality companies. You may not overperform over time because you might be overpaying for particular quality in a company, but when you add that valuation component, it gives you that right entry point. Hopefully it'll help you capture an appreciation in that particular performance, and then you can reset and look for another opportunity in the marketplace.
Absolutely. So a lot of advisors and investors have put a lot of money into pure beta strategies, low-cost beta, pure beta strategies. There's a lot of discussion about smart beta and the proliferation of smart beta, so many different factors or multi-factor strategies. Where does this fit into the whole mix?
Smart beta is everywhere, so it's definitely part of that equation. I think it's part of that conversation. It is a smart way of investing, but I think it's very differentiated because there's a human element at play, and that's the Morningstar equity research process. But it's also very forward-looking. I think that's one major distinction, where many of these smart beta factor strategies are based on metrics that look backward, whether it's valuations or profitability, leverage, things of that nature. It's all very backward-looking, where Morningstar, they're trying to forecast profitability into the future to derive at a moat rating. Same on their valuation side. They look at cash flows into the future to try to determine a current valuation. So it's very differentiated in that regard.
Yeah, absolutely. Well, I love it. It's fantastic. Brandon, as always, great to see you.
Likewise.
Thanks.